Power moves markets. Capital shapes the world. This is Behind Capital.
Every day, the world consumes more than 100 million barrels of oil. This oil powers cars, airplanes, factories, and global trade. But nearly 20% of that oil passes through one narrow waterway in the Middle East. A choke point so critical that if it were blocked, the global economy could feel the shock within hours. That choke point is the Strait of Hormuz. And today, rising tensions involving Iran are putting this fragile system at risk. If the conflict escalates, the consequences could spread across energy markets, financial markets, and global trade. Because when oil stops flowing, the global economy starts breaking. Global oil system. The modern economy runs on energy. In 2024 alone, the world consumed more than 100 million barrels of oil per day. Much of that oil comes from the Middle East. Countries like Saudi Arabia, Iraq, United Arab Emirates, and Iran are among the largest oil producers on Earth. Their exports power the economies of China, India, and the European Union. But this entire system depends on one vulnerable route: Strait of Hormuz. Between Iran and Oman lies the Strait of Hormuz. At its narrowest point, it is just 33 kilometers wide. Yet every day, around 21 million barrels of oil pass through this small corridor. That is nearly 1/5 of global oil supply. If shipping here were disrupted, the shock would be immediate. Oil prices could surge, energy markets could panic, and inflation could rise around the world. Oil price shock. History shows how dangerous energy shocks can be. During the 1973 oil crisis, oil prices quadrupled. The global economy plunged into recession, and decades later, energy markets remain just as vulnerable. Today, analysts warn that if the Strait of Hormuz were blocked, oil prices could surge above $150 per barrel. The global oil market. To understand why the conflict around Iran matters so much, we need to understand how fragile the global oil market really is. Oil is not just another commodity. It is the foundation of the modern global economy. Today, the world consumes more than 100 million barrels of oil every single day. The United States alone consumes around 20 million barrels per day. Meanwhile, China, the world's largest oil importer, consumes roughly 15 million barrels per day. Even small disruptions in supply can create massive price shocks, because global oil markets operate with very little spare capacity. In other words, there's very little extra oil production available to replace a sudden loss of supply. Why the Strait of Hormuz matters. This is why the Strait of Hormuz is considered the most important energy choke point in the world. Every day, around 21 million barrels of oil pass through this narrow waterway. That is nearly 1/5 of all oil traded globally. Oil tankers leaving the Persian Gulf must pass through this corridor before reaching international markets. Countries like Saudi Arabia, United Arab Emirates, Kuwait, Iraq, all rely heavily on this shipping route. If tankers cannot pass through the Strait of Hormuz, millions of barrels of oil could disappear from global markets almost overnight. How oil shocks trigger economic crises. Energy shocks have historically triggered some of the worst economic crises in modern history. One of the most famous examples was the 1973 oil crisis. When oil supplies were disrupted, prices quadrupled. Inflation surged across the world. Economic growth collapsed, and many countries entered a deep recession. Even decades later, the global economy remains extremely sensitive to energy shocks. When oil prices rise sharply, the cost of transportation increases. Factories face higher production costs. Food becomes more expensive to produce and transport, and consumers begin to spend less. Global trade risk. The risks are not limited to energy markets. The Middle East is also a critical hub for global trade routes. Every year, trillions of dollars worth of goods pass through shipping lanes connected to the Persian Gulf. If conflict disrupts maritime traffic, insurance costs for shipping companies can skyrocket. Cargo ships may be forced to take longer and more expensive routes, and global supply chains could face new delays. This would add even more pressure to an already fragile global economy. Global impact. Higher oil prices affect nearly every part of the economy. Transportation becomes more expensive. Shipping costs rise. Food prices increase. Air travel becomes more costly. This is known as the energy inflation effect, and historically, many global recessions have been preceded by sharp spikes in oil prices. The worst-case scenario. Economists often talk about the worst-case scenario. In this scenario, a large-scale conflict disrupts oil exports across the Persian Gulf. Shipping through the Strait of Hormuz becomes unsafe, and millions of barrels of oil disappear from the global market. In such a situation, oil prices could surge above $150 per barrel. Fuel prices would spike across the world. Inflation could rise rapidly, and global financial markets could face another major shock. Conclusion. For decades, the global economy has relied on a fragile energy system, one where a single choke point can influence fuel prices across the entire planet. That is why tensions involving Iran are not just a regional issue, they are a global economic risk. Because when energy markets panic, the entire world economy feels the shock.